Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Say you are 65 years old. Over the last 30 years, you've been smart. You bought duplexes, you fixed up fourplexes, maybe you even bought a small strip mall. You have built a portfolio worth $5 million. You are a success story. But there is a problem. You are tired. You are tired of the late night calls about leaky roofs. You are tired of chasing rent checks. You want to travel with your grandkids. You want to be done. So you call your CPA and say, I want to sell everything and put the cash in the bank. Your CPA runs the numbers. Between federal capital gains, state tax, the net investment income tax, and the massive depreciation recapture bill from 30 years of write-offs. If you sell that $5 million portfolio, you will write a check to the government for nearly $1.5 million. You are trapped. You can't afford to sell, but you don't want to work. These are the golden handcuffs. Today, we are going to unlock them. We are talking about the Delaware Statutory Trust, or DST. It is the institutional exit ramp that lets you keep your wealth, keep your tax deferral, and never fix a toilet again. Hey, Prime Investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. We are in the expand phase today, specifically expanding into institutional passive ownership. As always, I am not a CPA, I am not an attorney, and I am not a securities broker. DSTs are complex financial products governed by securities laws. They are generally available only to accredited investors. This is high-level strategy, not financial advice. Always consult your professional team. Now let's find the exit ramp. What is a DST? The fractional giant. To understand a DST, you have to change your perspective on ownership. In your current portfolio, you own the whole pie. You own the deed to the duplex. You make every decision. A Delaware Statutory Trust is a legal entity that owns a massive institutional-grade asset. We're talking about a $100 million Class A apartment complex in Dallas, a FedEx distribution center, a medical office building leased to a major hospital system. In 2004, the IRS issued Revenue Ruling 2004-86. This was the game changer. It said that a beneficial interest in a DST qualifies as like-kind property for a 1031 exchange. Translation: you can sell your $1 million duplex where you plunge the toilets and exchange that money tax-free into a fractional slice of that $100 million apartment complex where a professional management firm handles everything. You go from being a landlord to being a beneficiary. You still get monthly cash flow. You still get your share of the appreciation when the asset sells. You even get to keep taking depreciation on your tax return to shelter that income. But you have zero responsibility. You have no vote. You have no control. You are a passenger in a Ferrari, not the driver of a minivan. Beyond the total portfolio exit, DSTs have a tactical use that every active investor needs to know about. I call it the boot fixer. We talked about 1031 exchanges in episode 101. One of the biggest stressors in a 1031 is trying to match the values perfectly. Let's say you sell a property for $1.2 million. You find a great replacement property, a new apartment building for $1 million. You have $200,000 left over. In 1031 speak, this leftover cash is called boot. And unlike the rest of the money, boot is fully taxable. You might get hit with a $60,000 or $70,000 tax bill just on that leftover cash. Most investors panic. They overpay for the replacement property just to use up the cash, or they buy a second terrible property just to fill the gap. The pro move, you put the $200,000 into a DST, because DSTs allow for fractional investment, often with minimums as low as $100,000. You can use them to top off your exchange. You buy the $1 million active property you want, and you park the remaining $200,000 in a passive DST. You have now deferred 100% of your taxes, optimized your active deal, and diversified into a passive asset. It is the perfect gap filler. The great trade-off, control versus freedom. Now, I need to be real with you. The DST is not magic. It is a trade-off. You are trading control for freedom. When you own the duplex, you can force appreciation. You can paint the kitchen, raise the rent, and increase the value. You can refinance whenever you want. You are the pilot. In a DST, you are mute. The sponsor makes all the decisions. They decide when to renovate. They decide when to sell. If the market crashes and they decide to hold for 10 years instead of 5, you wait 10 years. It is completely illiquid. You cannot sell your shares on a secondary market easily. Once you are in for the ride. And let's talk about returns. If you are an active value-add investor, you might be used to making 12%, 15%, or 20% returns because you are working for it. DSTs typically target lower returns. They are buying stabilized, lower risk assets. You might see cash flow in the 4% to 6% range and total returns in the 7% to 9% range. To the active 30-year-old hustler, that sounds boring. But to the 65-year-old with $5 million, 5% cash flow on $5 million is $250,000 a year of truly passive income without waking up to a single tenant complaint. My point of view is this: return on equity, ROE, is important, but at a certain stage of wealth, return on hassle becomes the most important metric in your life. The sponsor trap. If you decide to take this exit ramp, your success depends entirely on one thing: the sponsor. You are handing your capital to a firm to manage. If they are incompetent, greedy, or inexperienced, you can lose your principal. In 2008, many tenant-in-common (TIC) structures, the precursor to DSTs, failed because sponsors over-leveraged the properties. When values dropped, the banks foreclosed, and investors were wiped out. So how do you vet a DST? You need to look at the master lease structure. You need to look at the fees, which can be high, often 5 to 9% upfront load. But mostly, you look at the track record. How many full-cycle deals have they done? Did they lose money in 2008? Did they lose money in 2020? Are they putting their own capital into the deal? Do not buy a DST based on the pretty brochure pictures. Buy it based on the balance sheet of the sponsor. This concludes our two-part advanced series. We've covered how to wipe out active income tax with REPS, episode 107, and how to retire from active management with DSTs, episode 108. These are the tools of the wealthy. They don't just buy houses. They build tax-efficient machines and then deploy capital into institutional assets. Your challenge today: I want you to calculate your return on hassle. Take your most annoying rental property, the one that gives you headaches. 1. Calculate the annual cash flow. 2. Estimate the hours you spend worrying about it, managing it, or dealing with it. 3. Ask yourself, if I could swap this for a check that is 20% smaller but requires 0 hours of my time, would I take that deal? If the answer is yes, it's time to start researching the DST exit ramp. I'm Martin Maxwell. We've built the foundation, we've expanded the empire, and now we know how to enjoy the harvest. Keep learning, stay strategic, and keep building one step at a time.